All right, we are looking at a classic market disconnect today. The headlines are painting this picture of a total collapse for a company, but the institutional data, well, that's telling an entirely different story. And this isn't about feelings or sentiment. This is about a structural divergence in the market that we absolutely have to break down. So let's cut right through the noise and get straight into the numbers. Okay, here is our case study, NFE. Now, the narrative on the left is what everyone sees, right? A 90% drop in price, talk of weak fundamentals, project delays, the whole 9 yards. But the microstructure data on the right, that tells the real story. We're talking 47.3% of the entire float is short. The fee to borrow shares has spiked to 100%, and liquidity has completely evaporated, literally zero shares available to borrow. Look, this isn't just a disconnect, this is a critical anomaly. It's a huge gap between the story being told and the actual mechanics of the market. So what does all this data actually point to? Well, it points to the textbook mechanics of a short squeeze. This kind of setup is like a tightly coiled spring, just absolutely loaded with potential energy, just waiting for a catalyst to set it off. Now, the fuel for this coiled spring is something called short interest. Think of it as the total percentage of a company's shares that are being bet against. When this number gets this high, it's a huge red flag for a dangerously crowded trade, where pretty much everyone is betting on the exact same negative outcome. And this is where the context becomes absolutely critical. Look at this. The average short interest across the market is tiny, maybe 5%. We usually start flagging a potential squeeze at around 20%. NFE is sitting at 47.3%. This isn't just high, it's an extreme statistical outlier. We're talking more than double the standard threshold. This right here is the rocket fuel for a potential squeeze. So how does that fuel ignite? A squeeze usually unfolds in 4 pretty distinct stages. First, you get this immense pressure building from the extreme short interest. Then, boom, a positive catalyst comes out of nowhere and sparks the initial buying. That new volume drives the price up, fast. And then you get the final critical stage. The rising price forces the shorts to start covering. They have to buy back shares at higher and higher prices, which creates this powerful feedback loop that just keeps fueling the rally. This quote from shortsqueeze.com just sums it up perfectly. Short interest is the fuel, performance is the fuse. You can have all the fuel in the world piled up, but you still need that spark. And that spark is the catalyst, the unexpected good news that lights the fuse and sets off the whole chain reaction we just walked through. But listen, the mechanics are only half the story. To really understand the full picture, you have to follow the money. In a setup this extreme, we have to analyze the institutional playbook and look for their footprints in the data. And those footprints, they're crystal clear. The extreme borrow fees tell us it's getting incredibly expensive, even painful, to maintain a short position. You see spikes and failure to deliver, which is when borrowed shares aren't returned on time. That suggests an extreme scarcity of shares. The options market is pricing in way more upside potential. And maybe most telling of all, institutional filings show that major hedge funds were actually accumulating shares last quarter. This isn't retail sentiment, folks. This is institutional positioning. And this brings us to the million-dollar question, doesn't it? If the public story is so negative, why on earth would sophisticated hedge funds be buying into a company that on the surface looks like it's in deep trouble? Well, it's not a conspiracy. It's what we call a strategic divergence. They see the same data we do, the extreme short interest, the high cost to borrow, and they are positioning themselves for the other side of that very crowded trade. They're betting on the spring uncoiling. So, where does that leave us? What's the outlook? Well, we have a classic conflict on our hands, a deeply negative fundamental narrative going head-to-head with some incredibly powerful technical and structural pressures. The outcome from here is entirely data-dependent, and it really leads to 2 very distinct, very different scenarios. So here's the breakdown. The bull case is all technical. A massive short squeeze gets triggered, either by forced covering or some big news catalyst, like a FEMA payment confirmation or a new LNG contract. The bear case, on the other hand, is purely fundamental. The negative story is true, the company defaults on its debt, and the stock heads towards zero. This is a classic binary setup. High risk, high reward, and it's defined entirely by these 2 opposing forces. In a high volatility environment like this, the strategy isn't to predict the future, it's to react to the data as it comes in. The absolute key here is risk management. So stay disciplined and stay liquid.
We are tracking these flows in real time. While you analyze the next move, check out the tools in the description. Sign up for Public to get $20 in free assets, check Webull for that BTC promo, or look into NVIDIA on Moomoo. All those links are down below. And hey, like and subscribe for more deep dive analysis.
And please always remember, this analysis is for educational purposes only. It's based on current data, which can change in a heartbeat. This is not financial advice. All investment decisions involve risk, so please always do your own due diligence.